Let's talk about corporates which have come out with numbers. Firstly, Bajaj Finserv, they posted a robust fourth quarter, 28% jump in profits. Other ratios seemed okay too. This was largely driven by contribution from Bajaj Finance, but the insurance arms too posted a reasonably steady growth. To talk about the growth drivers in the quarter gone by and the outlook ahead, joining us on the phone line is the Chief Financial Officer, Mr. S Sreenivasan. Mr. Sreenivasan, good having you. Thanks so much for joining in. Can you sum up the quarter for us? Multiple moving parts, life insurance, general insurance, and even those varied a bit. How was the quarter for you?
We are very satisfied with the performance of all our three engines, the finance company, Bajaj Allianz, general insurance and life insurance. Bajaj Finance, I think the momentum has been very strong now. I think we have had another record year, highest AUM, highest profit after tax, very low NPAs. I think there is hardly anything that we can point out which hasn't worked better than what we expected. Quarter four particularly was very strong for Bajaj Finance. Profit increased by 61%, which given the general conditions in the market, I think it is a very satisfactory result. We are well capitalized in Bajaj Finance. I think we raised capital early this year in the second quarter. So we are good to go for another 3-4 years. During the year, we also set up Bajaj Housing Finance because that was one area where, because the returns were very low, traditionally we have not been as strong as the other lines of business. But with this Housing Finance already we have touched AUM of 3,600 crores or so. And over the next 3 to 4 years, we will be scaling up that business. It will work on a lower cost model. Traditionally, Housing Finance has very low NPAs. And I think with our ability to cross-sell select customers and focusing on mass affluent customers, we think we should be able to deliver reasonably good ROEs from that business as well. In a general insurance company, again, it has, we think, based on the results of the top companies which have come out, we think we will have the highest profit in the private sector for this year as well. Our combined ratios are exceptional. I think 92.3% for the year is one of the best in the market. The profit growth for the year has been very strong as well. We have grown our PAT by about 27%. Even excluding crop, our growth rate has been 22%. We do crop insurance business in line with our market share. So we are neither overly aggressive nor overly conservative there. So this year, overall, we have done about 1,850 crores of crop insurance business. In the life insurance business, our focus for the last 2 years or 8-10 quarters has been to re-engineer the growth. And I'm happy to report that our overall growth for Q4 and for the year has been very strong. Our rated premium has grown by almost 38% for the year, which is one of the highest in the market. We have improved our persistency by almost 9%. Historically, because we were in rural markets and in lower ticket sizes, our persistency was not as good as the top companies, but I think we are catching up pretty fast. And by this coming year or the year after, we should be in the 80 to 85% bracket, which is among the top companies' persistency ratios in the 13-month basis. So this business, I think, as we are rebuilding growth, it will have new business strain, which means the new business will produce a loss and the renewal business produces profits.
Okay.
So we think that till the growth stabilizes to normal levels, we would have that strain. But my feeling is about 2 to 3 years' time.
Okay.
We should see the reported profit also grow.
Okay, fine. Mr. Sreenivasan, if I can just come in and put in some questions here, slightly running short of time. The gross written premium for life insurance is growing well, but how has renewal premium been in this quarter? Because if I remember last quarter too, it grew at a slower pace.
See, the renewal premium comes from the past book. And if you remember till 2014-15, we had a renewal book which was very low ticket and we had issues of persistency. So what you're seeing now is actually the effect of what we have written in the last 2 years, and that is why we are seeing the renewal growing now. I think last year we grew and this year we are growing even stronger. And going forward, we expect renewals to be a big component of our strategy. It will take us another 2 to 3 years before we reach the right mix of renewal and new business, so that the reported profit also grows much stronger. So we think we are doing a very good job in renewals. But next year again, with further improvement, if we achieve, we think we'll be in a significantly better position.
Okay. While you mentioned that the 13-month persistency is improving, what about the 61-month persistency ratios? How have they shaped up for you in the life insurance business? Or the general insurance for that matter?
The 61st month, till a few years ago, especially before we had the old policies, before the unit-linked guidelines were changed, I think many companies had very low persistency on 61st month, and ours also was somewhere around 10% or so. Now we have been growing that very strongly. We have now reached about 31.6%. Now 61st month actually relates to 33%. 61st month actually relates to business you wrote in 5 years ago. And with unit-linked business, after 5 years, the lock-in will expire. So traditionally, it is how far you retain those customers is very critical. We think over the next 3 years, we should see that growing, because we have seen growth in not only 13th month, 9%, we have seen 25th month growing by 7%, 37th month growing by 5%, 61st month growing by 2%. So it is growing across the board. As we are writing more and more good quality business now, we think we will see significant growth in these persistencies going forward.
Okay. Let's hope for that. What about the market share, life insurance, general insurance? Will you grow the market share, or will you stay steady at these levels and you will see growth despite staying steady?
See, in general insurance, we are now at about 7.1% market share, and that has grown by about 0.4% this year. The way we look at market share is twofold. A, we want to be growing our market share in those segments we think we are strong at and where we believe there is more sustainable profit. So like retail health, we would like to improve our market share. We would like to improve our market share in property business. Motor, we would like to maintain our market share. In group health, it is very, depending on the pricing, we may increase or decrease our market share. So it's a business of selection. Overall market share we think will improve, but it is not like quantum improvement. It will be small improvements over time, but in the segments that we prefer. In crop insurance, we would roughly maintain our market share at about 7%, because that's a highly catastrophe-prone business and significant reinsurance support is required. So we would play that cautiously in those areas where we feel we are comfortable with, in terms of claims, our understanding of the crops, the availability of reinsurance support, the type of pricing we get, and more importantly, the frequency and the speed with which we receive the premium payments.
Last question, Mr. Sreenivasan, within your businesses, with all that's happening with Allianz as well, are you looking for a new partner? And part two of my question is in the same vein, are you looking to list the insurance businesses separately at any point of time in the next 12 months?
Our relationship with Allianz are extremely cordial. Allianz has reiterated to us their commitment to remain in India and with us. They have not yet taken a call as to raising their stake, so the status quo remains there. But they are very closely involved with the businesses, and we are closely engaged with them in many aspects of the business. So we think the partnership is much stronger now than before. As for the second question, we are not yet ready for a listing. In the foreseeable future, we don't see the need to list, because the companies are sitting on significant solvency surpluses. So the companies themselves do not need the money. So at least for the next 5 years, I don't see a possibility that we might list. This year, however, we have started paying a token dividend from both the companies, about 1.5 to 15% of their profits, which will come to both us and Allianz. So that is only change because of the significant solvency surpluses they have.
Okay, Mr. Sreenivasan, we'll leave it at that. Thanks so much for taking the time out and speaking with us. Appreciate your time.